Hi there, Mike Brady with Generosity Wealth Management, a comprehensive financial services firm headquartered right here in Boulder, Colorado. First quarter is over, 2019, and it was a banner year. These are the types of quarters that investors and financial advisors, frankly, live for. In a very short amount of time, we wiped away all of 2018's losses in the unmanaged stock market indexes. Today, I want to talk about humility and bias because I think that they're very important. Just frankly, 3, 4, 5 months ago, there was so much, things are horrible and the stock market's continuing to go down, a lot of pessimism. And then there was lots of optimism in January and February, followed by, frankly, just 3, 4 weeks ago, I was reading an awful lot of pessimism. And the reason why I bring this up is humility. I don't know the future any more than you know the future, and definitely not any more than those that you see on TV or writing those newsletters or those magazine articles. Take it with a grain of salt, okay? Because I think that it's important for us to have a long-term plan, stick with it, and not get too deviated by their particular biases. And so now I want to kind of shift into bias. The bias of those in the media is not to be even-keeled. It is to be sensational, either to pump things on the upside and be overly enthusiastic, or to be very negative, okay? Just to say, oh my God, the world is about to end. Because both of them get headlines, both of them run the viewership up into record digits. Saying, oh, everything's all fine, let's just do the middle way, doesn't really fly. And so you've got to read or listen to your news that way with that particular filter. I would actually argue that's a good way to go through life because, what is your personal bias? Is your personal bias to be optimistic or to be pessimistic? Right now, I'm just telling you that going back to 1929, 3 out of 4 years is positive. 1 out of 4 has been negative in the unmanaged stock market indexes. So that means that if you're pessimistic, you're really only right 1 out of 4 times. Being pessimistic might serve you well if you are in a bad neighborhood, to keep your guard up, to be fearful. But it doesn't really serve you very well, frankly, in your investments. Okay, so think about it even from a relationship point of view. If you are afraid of being disappointed in friendships, is the answer to have no friends? No, the answer is, why don't I look at myself and see if I can moderate my reaction to my disappointments when a friend might disappoint me. That's the more logical way, I would argue, in your relationship, your friend relationships, but also as it relates to investments. Is the better way to be overly optimistic, overly pessimistic, or to take your news with a filter, but look for the even way, to understand that, hey, my bias might be pessimistic, but wait a second, is this the real truth? Recently, and before I end here, today's newsletter is, there's been a lot of talk about the inverted yield curve, and I wanted to talk about that for a second. The recession is not the stock market, okay? That's very important to make that differentiation. The inverted yield curve, and we could talk about how the difference between the 10-year and the 2-year, maybe I'll do that in an instructional video next month. But when you see that, yes, that has led eventually, or at least predicted most of the time, to a recession. But it's been a huge differential between 7 months and 19 months. And during that time, as I look back over the last, I'm going to put a graph up there on the screen, there's been some nice stock markets during that time frame, and some nice times to be invested. This might be, I would argue that since there's a huge variance there of delay and some false positives, that it's not as good of an indicator as you would be led to believe. But even then, it's an indicator of the economy. The economy is not the stock market. Okay, very important to remember that. Okay, if you look back at the early 90s, there was a indicator of a recession, which did happen. However, does that mean that you shouldn't have investments? No way. The 90s were one of the best 10-year time frames ever. And I certainly wouldn't take that as an indicator. The last 10 years has been a relatively moderate recovery from the Great Recession. Okay, when you look at all the underlying GDP numbers versus the averages. However, this last 10 years, I'm certainly proud that many people invested in the markets and kept their investments over the last 10 years. The unmanaged stock market indexes have been very favorable, even if the economy was not as ripping and roaring as they have in prior decades. So anyway, Mike Brady, Generosity Wealth Management, 303-747-6455. Give me a call at any time. Have a wonderful day. Thank you. Bye-bye.